All right. So, we're diving into property investment today, and you've sent over some really interesting stuff uh, about this whole world, looking at some of the good, the bad, and the ugly.
Yeah.
We're talking Faridabad, Noida, but then also kind of zooming out and thinking about smart ways to put together, a really solid property portfolio.
Mm-hmm.
So our mission here is to really, sift through all of this and pull out the absolute gold nuggets,
Yeah.
give you those clear takeaways,
Yeah.
and make sure that you come away from this feeling like you've got a better path forward in the world of property.
Yeah.
We want you to be empowered. We want you to have that actionable knowledge without, totally overloading you with information.
Yeah.
And I think that's what's great about the notes you sent over. We've got a mix of, real on-the-ground observations, some
Yeah.
broader kind of trends, some analysis. So let's jump in.
Absolutely. And I think, one of the things to address right up front
Mhm.
is, some of the potential pitfalls that you've highlighted, right? The stories from Faridabad and Noida are really telling because they show that the quality of developers can be wildly different.
Oh, yeah.
And that can make or break an investor's, experience and their financial outcome.
It's not just about, the buildings themselves. It's about who's behind them.
Absolutely.
And one thing that really struck me from your notes is that just because a developer is listed, on the stock exchange,
Right.
it's not a guarantee
No,
that they're a safe bet.
not at all.
We've seen cases where publicly listed companies,
Mm-hmm.
developers,
Mm-hmm.
have really run into trouble. So it just goes to show you got to look beyond the name.
You really do. It's all about digging deeper, and that's where, the financials come into play.
Okay.
And one of the big red flags that your research points to is this idea of over-leveraging,
Yeah.
which essentially means the developer has taken on way too much debt
Right.
compared to their assets. So, it's like a house of cards.
Yeah, I was going to say it's like maxing out all your credit cards,
Yeah.
hoping that, everything goes perfectly.
Right.
But then if there's any hiccup,
Any slowdown,
Yeah.
any delay, it all comes crashing down.
yeah, the interest payments, everything.
And that's why, the notes emphasize looking at their balance sheets.
Mhm.
It can seem daunting, but it's really about understanding their financial health.
Yeah, and even if analyzing the whole balance sheet seems a bit much, is there one key figure that can kind of give you a quick snapshot?
There is, and it's called the debt-to-equity ratio.
Okay.
And you can usually find that in their annual reports on their website.
Okay.
A good rule of thumb, and again, you should always research industry specifics, but generally if that ratio is way above 1.5,
Okay.
that's a sign to look a little closer.
That's a good initial red flag or green flag, I guess.
Yeah, quick indicator, yeah.
Now let's shift gears a bit.
Yeah.
One of your notes mentioned these really high rental returns
Right.
being promised on commercial properties.
Mhm.
And that kind of sounds like, the classic too good to be true scenario.
Absolutely. And what often happens is, investors get lured in by these big promises.
Yeah.
But the reality is the actual rental income ends up being way lower
Right.
than what they projected.
So they're stuck with a property that's not really performing.
Exactly. And a good rule of thumb there is if it sounds dramatically better
Yeah.
than average market returns, it probably is
Yeah.
too good to be true.
And it was interesting to see in the notes that sometimes inheritance money
Right.
is invested kind of less cautiously
Yeah.
into these riskier ventures.
Yeah.
It's like, maybe because it wasn't earned through, years of work,
Right.
it somehow feels different.
It's like found money.
Yeah. And I guess our judgment can be a little bit clouded.
Yeah, that ties into this whole field of behavioral finance, how our emotions impact our money decisions.
It's fascinating.
It is, yeah.
So we've talked about some of the traps now. Let's talk about what smart investors do. Your notes really emphasized choosing developers with a strong national presence
Mm-hmm.
and a proven track record.
Absolutely. Longer history usually means more data,
Yeah.
to see how they've actually performed on their projects.
And I thought it was really smart, the idea of considering government authority plots,
Right.
especially in smaller cities.
Yeah. In those less developed markets where, the private developers might be a bit more unpredictable,
Yeah.
that government backing can offer a lot more security.
It makes sense because often there's more regulation,
Right.
potentially less risk of those projects being abandoned.
Absolutely.
But then on the flip side, in the larger cities,
Mm-hmm.
the more established ones,
Mm-hmm.
sticking with those big name reputable builders
Yeah.
can also be a really smart move for both security and returns.
Yeah, you get that brand recognition,
Yeah.
the track record, and you can usually access their financials pretty easily.
So it sounds like the strategy kind of adapts
Yeah,
to the specific market.
precisely. And being able to actually look at their numbers,
Yeah.
go beyond just the marketing hype.
Yeah.
That's a huge advantage.
So beyond the debt-to-equity ratio,
Mm-hmm.
you mentioned another key metric to look at, which is project sales velocity.
Yeah, and that's basically how quickly they're selling units in their projects.
Okay.
So if things are moving fast,
Yeah.
that usually means there's strong demand, they've got good cash flow to keep the project on track.
And if things are moving really slowly,
Yeah, it can be a red flag, yeah.
maybe the project's overpriced.
Yeah, or facing some negative perceptions.
Yeah.
Definitely.
Now, here's a point that I think can really shift perspectives.
Yeah.
You don't necessarily have to live in a property to make it a good investment.
Exactly.
The rental income, could potentially cover your own rent somewhere else.
It's all about thinking about real estate as an income-generating asset.
Yeah.
And technology has made it so much easier
Yeah.
to manage properties remotely.
You can do everything online these days.
You can, yeah.
Tenant screening repairs, rent collection.
Exactly.
And some developers are even offering these ready-to-rent models
Right.
where they'll even, find the tenants for you.
Sometimes waive those brokerage fees.
It makes it even more hands-off.
Absolutely. But the key there is focusing on cities with strong rental demand,
Yeah.
places with lots of jobs, and a steady flow of people moving in.
Makes sense.
Yeah.
So let's talk about the market as a whole.
Yeah.
Your notes pointed to some huge price jumps in places like Gurgaon.
Right. And it's gotten to the point where affordability is a serious issue.
Yeah. And the examples you gave were pretty eye-opening.
They are? Yeah.
Affordable housing hitting 1 crore rupees.
A 2 BHK going up 4 times in value.
I mean, that's just wild.
And what's happening is you have this huge demand,
Yeah.
but the supply just can't keep up.
Especially at prices people can actually afford.
Exactly. So it creates this pressure cooker situation.
And then it pushes people to look at other cities.
Right. It's like a ripple effect.
Yeah. Where maybe things are still a bit more affordable.
Yeah.
And you also made an interesting point about reputable developers being kind of like a sign that a city is ready for investment.
Exactly. Because if those big players aren't there,
Yeah.
it might mean the market's still developing.
Yeah. But when a major developer comes in,
Yeah.
that's a good signal.
They've done their homework.
Right.
They see the potential.
Now let's talk about property bubbles.
Okay.
Your notes made it really clear that they don't just appear out of nowhere.
No, they don't.
They're a warning sign.
Yeah, there's some classic red flags.
So what should people be looking out for?
Well, one thing is prices going up way too fast
Okay.
without any real economic reason behind it.
Yeah, just pure speculation.
Right, people just buying because they think prices will keep going up.
Hoping to make a quick buck.
Exactly.
Dangerous game.
It is. And also, be wary of those super optimistic projections
Yeah.
that just seem detached from reality.
So if a city is starting to feel out of reach,
Right.
budget-wise, your notes recommend looking at other cities where those credible developers are still active.
Yeah, it's about finding that balance between growth potential and affordability.
And also diversifying your investments geographically.
Yeah, don't put all your eggs in one basket.
They spread the risk a bit.
Exactly.
Now here's a really strong word of caution.
All right.
Avoid those unfamiliar or weird builders,
Yeah, those are the ones to really watch out for.
especially in smaller towns where there might not be as much oversight.
Right, because in those less regulated environments, the risks are just much higher.
Yeah, you could end up with delays, shoddy construction, even fraud.
Yeah, it's just not worth it.
So it all comes down to prioritizing quality,
Absolutely.
both in terms of location and the developer.
And that might mean, going for a smaller property
Yeah.
than you initially thought, but it's better to have a piece of something solid
Right.
than a junk of something risky.
It's about the long game.
Exactly.
Okay, let's talk a bit about the financial planning side of things.
Sure.
Your notes mentioned some potential tax benefits,
Right.
especially when reinvesting capital gains into those residential properties under 2 crore rupees.
And joint ownership can really amplify
Right.
those benefits.
So definitely something worth looking into.
Absolutely, because understanding the tax implications is key
Yeah.
to maximizing your returns.
But you also gave a really strong warning. Don't base your financial decisions
Yeah.
just on hearsay or what a builder tells you.
Right, because you need that independent perspective,
Yeah.
that objective advice.
Get a professional involved.
Exactly, because compared to the cost of making a bad property decision,
Yeah.
the fee for financial advice is tiny.
It's like, if you were buying a luxury car,
Right.
you do your research.
Yeah.
You might even consult an expert.
Why wouldn't you do the same for real estate?
It's a huge investment.
It is, and without the right knowledge, it can be really tricky.
Yeah, there's so much to consider.
There is.
The legal stuff, market trends, developer financials.
It's a complex landscape.
So seeking advice, the worst case.
Yeah.
You spend a little time and money.
But the best case...
You avoid a massive mistake.
Exactly. It's that safety net.
Love that. Okay. Last but not least,
Mm-hmm.
you drew a really great analogy to the stock market,
Right.
explaining that, those struggling builders, those projects that go south,
Yeah.
they usually show warning signs.
They don't just collapse overnight.
That's like those publicly traded companies.
Right. There are usually signals.
Delays in projects.
Negative feedback. Maybe their stock price is dropping.
Yeah.
Rumors start swirling.
And some people see those signs and get out early.
Exactly.
Others hold on, hoping for a turnaround.
Yeah, sometimes it works out, sometimes it doesn't.
But often those problems with developers, they kind of snowball.
Right.
New buyers come in unaware of the issues.
And it just keeps going until it can't anymore.
So to sum it all up for you, our listener,
Mm-hmm.
the big takeaways are due diligence is key.
Absolutely.
Understand those developer financials. Don't fall for those too good to be true promises.
Right.
Focus on reputable builders, well-located properties.
Yeah.
And don't be afraid to get professional advice.
Solid advice. Yeah.
So as you move forward with your property investments,
Mm-hmm.
what are like the first 3 concrete steps you're going to take?
Yeah, what are those red flags you're going to be looking for?
Those are the questions to really ponder.
Absolutely.
We hope this deep dive has given you a clearer picture,
Yeah.
more solid foundation to make those smart decisions.
Mm-hmm.
That's what we're all about here, giving you that shortcut to being well-informed.
That's it.
Thanks for joining us on the deep dive.
Thanks for having me.
We'll see you next time.
See you later.